Today we're going to be talking about the dark side of this market that is looming under the surface in front of all of us. We're also going to talk about trade setups as well as this economic optimism index that came out this morning, which caused some volatility. Let's jump in. All right, guys, so first of all, I just wanted to take a look at the markets as a whole. We can see the S&P 500 wicked higher and then came down and is trading sort of sideways on the day. NASDAQ is down slightly on the day. You've got the Dow also actually outperforming here slightly today, which is interesting. At the same time, you've got the US dollar selling off, as well as the euro and the pound having a good day so far. Gold is also seeing a fresh daily high at the time of recording, 2,036 an ounce, and oil is just off of its lows at 72 or so US oil. That being said, UK oil, of course, being different, but overall, some volatility here in the markets here today, and I want to jump in and discuss it with you guys now. So this morning, something came out that kind of moved the markets a little bit. It was the economic optimism index in the US, which fell to 44 in February from 44.7 in January, which was well below forecasts of 47.2. So when you get reads like this, it definitely causes some stir in the markets. Let's talk about how this could impact the dollar, gold, etc. All right, and here we are taking a look at the US dollar index. We can see here we're on a daily chart. We were in this longer term downtrend, and it seems like we're kind of in a secular shift. We've seen a trend here now forming to the upside. And with this data, we actually saw the dollar start to move slightly lower here. Again, economic contraction in any shape or form in terms of forecasts can be bearish for the US dollar. But overall, we've still seen strong NFP. We saw the Fed mention that rate cuts in March are probably not happening. All of those things combined have caused the dollar to be strong recently. And so what I think is kind of interesting here is the market's reaction is exactly what we would have expected. So we saw some dollar weakness, and this dollar weakness is combined with sort of the dark underside of this market that I want to get to in just a moment. But we see the dollar index holding steady here at 104, which I think is a key level for the bulls. Again, we broke out of this level. It was a key level of resistance looking left. And so now it's trading above there. As long as we stay above that, I am tactically remaining bullish on the dollar in the short term. And gold saw a little bit of a rally here. If we drop it down to the 4-hour chart here, you can see what was kind of this resistance area. Gold is attempting to break back above that. Now, this market has been really choppy recently and not something that I've been trading all that much, but I thought this was worth mentioning. A slowdown in the economy usually is bullish for gold, and that's what we're kind of seeing. Forecasts for slowing in the economy are going to, like I said, they're going to be strong for gold in the short term as we've rallied back from this 2017 level or so that we were trading just recently. In terms of forecast for gold, for me, it's really not a market that I have a strong conviction in. It seems to be ranging on the daily and 4-hour chart, so I'll probably stay away unless we get a breakout one way or the other on some key economic data. And here's the smart money versus retail money. We have our smart money indicator on the edge finder. I've got gold pulled up here so we can take a look at this together. And what we can see is the blue line represents institutional money from the COT data. We can see it's been steadily climbing more and more bullish here recently. And you can see in white, that's the price of gold. So gold has kind of been consolidating, but it seems like institutional money is still net pretty bullish on this, and I thought that was worth mentioning. We've been steadily climbing in terms of institutional money, and retail traders have overall been pretty bearish, but just slightly bullish on it recently. But really, this 0% line shows you all you need to know. Retail traders are kind of mixed, but institutional money seems to be steadily accumulating gold, and I'll be watching this one close to see where it goes. Also, while we're on the subject, if you'd like a trial of the software, we do have that available now. You can click the link down below in the description to sign up for a trial, try it out for 30 days, see if this tool would be something that you'd be interested in buying for the long term. And again, all you got to do is apply for that down below in the description. All right, guys, and here is the topic of the day. Today, we are talking about what is kind of scary in this market. And for the index traders, pay close attention. This is really, really key here. The concern that I have right now is that this is a tale of two markets. And if you don't know what I mean by that, well, it's a common phrase when certain areas of the market are doing remarkably well and most other areas are doing not so great. And so we can see that very easily illustrated with this NASDAQ chart, which is showing that tech-heavy areas, especially the semiconductor area of the market, is doing remarkably well. We're seeing massive, massive outperformance. Meanwhile, the Russell 2000, which is small cap stocks, has overall just not seen the same love. We've really traded sideways for a very, very long time here for the last few years. My point with showcasing this and why it matters is that when you get this very, very little breadth, as they call it, meaning it's not a very dispersed or widely spread rally in markets, it's concerning because, again, if only a small area is participating, does that hint that perhaps the other areas of the market that are lagging are telling you something about the overall broad, look at where stock earnings are going? And if you're an index trader, this is important because this would actually suggest to me that the NASDAQ very well could rapidly pull back. Now, you could also make the point that the Russell could catch up a lot, and I think that could be part of the trade, but I think both of these things can actually coexist. You may actually see an environment where the NASDAQ starts to pull back slightly with its very richly valuated companies like Meta, Nvidia. These companies, they do have the earnings to back them up, but any hiccup in those earnings could cause the NASDAQ to really pull back. Meanwhile, the Russell has such low expectations and its valuation is very low relative to its historical self, it could have a nice pump in the second half of the year as we see rate cuts come in. The reason is, at the end of the day, the rate cut story. Some areas of the market are more sensitive than others. The NASDAQ has a bunch of big companies that can support themselves even in the case that we don't see rate cuts, as long as the economy is hanging in there. Meanwhile, the Russell is pretty reliant. A lot of debt-heavy companies are in there, and they rely on lower interest rates in order to see, their growth really flourish. So I thought it was worth mentioning, and it's sort of that creepy dark side underneath the market that you got to be careful about when you see these big pumps in the NASDAQ and in the S&P. One more component to that story and why there is such massive outperformance, we can see the semiconductor ETF, SMH. This is a massive area of the markets. Computer chips like Nvidia, AMD, all those companies that make chips, they're doing remarkably well at the top. The highest, the big companies, there's like 5 real big semiconductor companies that are just massively, massively outperforming, and it's causing the NASDAQ and S&P to rally along with them. Meanwhile, the Russell does not have so much exposure to semiconductor companies like this. The put-call ratio also shows us something interesting. What this tells us is that a lower reading generally means the market is more bullish and there's a higher volume of calls relative to puts, and a higher reading means that puts are much more popular than calls. There's a much bigger volume for puts. What we see right now is there's sort of this kind of intermediary period, but if you're wondering when things get interesting, it's usually when we get a big spike one way or the other, where we see some very strong contrarian signals to possibly get counter trend to the market, or at the very least just get sort of away from trying to pile into the same trade. And this is of course oriented mostly for index traders. So if you're an SPX, or if you trade NASDAQ calls or puts, or of course if you just trade futures, or even with CFDs, whatever you trade, the point is if you trade the indices in any capacity, the put call ratio can be a very powerful indicator. It's also just good generally for market sentiment, even if you don't trade indices. And the investor sentiment survey also tells an interesting story. Market participants said 49% feel bullish, 26 or so percent say they're neutral, and 24.5% say they're bearish. This is actually an uptick, and we're seeing sentiment here get more bullish among participants that surveyed. Again, another contrarian signal can be waiting for this to get very extreme, in which case a lot of times the markets will often reverse from there. Not always and not immediately, but it could be an interesting signal to watch for. And just a reminder, the trial link for accessing our software here that we work so hard to build is down below in the description if you'd like to check it out for 30 days. Another interesting area of the market is the oil market, which has been kind of an interesting one to watch. We've seen a big explosion in the price of oil, and then it pulled back here pretty dramatically. But one area of the market that's interesting to me in relation to oil is the #1 consumer of Brent crude, which is, of course, China. And China actually has seen a pretty interesting breakout here today. I actually own the Chinese stock ETF FXI, and although I am very much not, actually I'm very slightly in profit on this position, it's a small position on the account and something that I'm watching myself. But again, if China does sort of see a continued rebound, another area of the market that could be a benefactor of that would be oil. If we see the Chinese economy come back online, again, their consumption of oil will likely increase alongside that. and cause the oil price to go up. So I thought that was kind of an interesting thing to watch. Again, I already have a long position on the Chinese stock market, although being very small, I think that the risk to reward looks pretty good. I talked about that on today's stream here with Frank, so maybe I'll pull that up here for you guys to watch that back. Also, if you're wondering how I can trade certain things like these ETFs that I'm trading, I trade with WeBull. There will be a link down below in the description to sign up with WeBull if that's something you're interested in. If you're in the US, if you're not in the US, there's also some great brokers that I recommend, especially if you're somebody trading FX from the US or FX from non-US places, indices. There's a whole list of brokers that might be helpful to you down below, and they all have special sign-up perks that you can check out. Here's a quick look at my positions while we're on the subject, sort of everything I've got right now. So my FXI position is up nicely overall now, which was down in the dumps. We also see some puts that I've sold, which are overall doing pretty good. As long as the market stays sideways or goes up, these puts that I've sold will do well on XLK, the Russell, IWM, and the tech ETF XLK. I also bought a very tiny position in a Bitcoin ETF, IBIT, and a small tiny position in silver SLV as well. The China trade kind of popped here a little bit in overnight session. I watched it last night. I got to get out of my China trades because you know what happens, Frank, is it makes the Asian session exciting for me. And I'm like, dude, I spend enough time looking at markets, but now suddenly I'm watching the Chinese open at 8 p.m. US Eastern. I'm like, okay, we gotta get out of the China trade for that reason alone. Too much markets. But the China trade kind of came alive. I've been calling this as now I got to say I don't even think I'm positive. I'm still in the red by $300, but that's a lot better than where I was, which was down 3,000. So let me show you this. But I wanted to point out our indicator actually helped me catch this trade. So I got this sort of alerted to me. I was like, oh, okay. So this is the CN50 USD, the China and ETF here. And it's been littered with these little green dots. And if you're asking what are those green dots and what's the significance, Frank actually designed this tool. We both kind of had this idea for creating sort of an overextended, similar to a Bollinger Band construct. And you can see it started printing over here. I was early to the trade. I think I bought it like 4 or 5 weeks ago. I bought it like right here. I think I bought like the short-term high and have been in the red since. But it started to print these oversold readings on the weekly chart. And I figured, okay, you know, part of the thing here of your oil trade is that if you think oil is going to rally big, one of the serious components that you need to play ball is China coming back. If China comes back, they're the leading consumer of Brent crude oil. And so I think we finally might be seeing, and I say might very, very carefully, because the Chinese economy, the Chinese government has a track record of being kind of untrustworthy to a lot of investors. A lot of US investors have completely moved out of the space. So please understand when I'm talking about this, there's a lot of risk with Chinese stocks in general. However, I think that, you know, we're starting to see the Chinese government want to play ball. They want to be back on the scene and get their economy rolling again. And I think we may be seeing some of that. We also have Alibaba earnings are on Wednesday. And so this stock is popping here pretty big. This is, of course, probably I think it's the biggest, most prominent name of Chinese stocks. It might be PDD, Pinduoduo. But regardless, we have Alibaba earnings on Wednesday. We saw more stimulus from the Chinese government. And Frank, I know I spoke a long time on this, but it just adds something to the oil trade. If China comes back, oil probably sees, you know, $80, $90 a barrel at some point. If you're looking to improve as a trader, we've got some cool free resources here that I wanted to share as we close today's video. Down below in the description, there is a link to join our Discord channel or our Telegram channel. And we also have our website, a1trading.com, where traders can get access to free course material to help you improve as a trader. Remember, we are also live Monday through Friday on this channel around 9:30 a.m. US Eastern, broadcasting most live news events and that sort of thing. So hope to see you there. And also, we do have a couple videos here showing up on the screen. If either of these seems like it might be helpful to you, then make sure to click here or here, and we'll see you there.